One day, your monthly loan payment quietly goes up. Not because you spent more, not because you missed a payment, but because somewhere, in a room you've never seen, a group of people decided to move a number by 0.25%. That number is called an interest rate, and it quietly controls almost everything in your financial life. Your mortgage, your savings, your job, even whether the economy feels like it's booming or collapsing. And the strange part, most people don't really understand what it is. So let's strip it down. No jargon, no equations, just the real mechanism. Imagine you have a toy, a really popular toy. Everyone wants it, but there's only one. So you say, sure, you can borrow it, but you have to give me one extra candy when you return it. That extra candy is interest. That's it. Interest is simply the cost of borrowing something. Now scale that idea up. Instead of toys, it's money. Instead of candy, it's more money. And instead of kids, it's banks, governments, and entire countries. Now here's where things get interesting. Who decides how much extra candy you have to give back? Because that one decision changes everything. Let's zoom out. There's a central authority in every country. Think of it like the referee of money. They don't print money every day. They don't hand out loans to you directly. But they control one powerful lever: the base interest rate. This is the starting price of money. When they raise it, borrowing becomes expensive. When they lower it, borrowing becomes cheap. And that single move ripples through the entire system. Let's walk through what actually happens. Say the central authority lowers interest rates. Suddenly, banks can borrow money cheaply. So banks turn around and offer cheaper loans to people like you. Now loans feel easy. You think, maybe I can afford that house. Or maybe I should start that business. Or why not upgrade the car? More people borrow. More people spend. Businesses see more customers. They hire more workers. On the surface, everything looks great. The economy feels alive. But something else is happening underneath. Money is becoming less scarce. And when something becomes less scarce, it becomes less valuable. That's when prices start rising. Slowly at first, then faster. This is inflation. Now flip the situation. The central authority raises interest rates. Now borrowing is expensive. Banks tighten up. Loans become harder to get. You look at that same house and think, actually, maybe not. Businesses delay expansion. Consumers spend less. And suddenly the economy starts to slow down. Less spending, less hiring, less growth. It feels like things are cooling off. Because they are. So in simple terms, low interest rates equals more borrowing, more spending, more growth. High interest rates equals less borrowing, less spending, slower growth. Sounds simple. Almost too simple. Because here's the uncomfortable part. This system doesn't just control growth, it controls pressure. Let's talk about debt. Most modern economies run on debt. Governments borrow, companies borrow, people borrow. Your mortgage is debt. Your credit card is debt. Student loans are debt. And all of it is tied to interest rates. When rates go up, the cost of all that existing debt goes up too. Not always instantly, but eventually. That's when things get tight. A homeowner suddenly pays hundreds more per month. A company sees its loan payments double. A government spends more on interest than on public services. And no one really gets a say in it. It just happens. Now here's where the system gets a little strange. Because interest rates aren't just about controlling the present. They're about managing expectations. If people expect prices to rise, they start acting differently. They buy sooner. They spend faster. They demand higher wages, which ironically causes prices to rise even more. So central authorities raise interest rates not just to slow spending, but to send a message, a signal. We're in control. Whether that's true or not is another question. Now let's look at the irony. When times are good, interest rates are often low. Cheap money fuels growth. But it also quietly builds risk. People take bigger loans. Companies overexpand. Investors chase returns. Everything stretches. Then, when inflation finally shows up, interest rates rise. And suddenly, all that cheap debt becomes expensive. That's when things break. Not always dramatically. Sometimes it's quiet. A company goes bankrupt. A housing market cools. Layoffs start appearing. And people wonder, what changed? Nothing visible. Just a number, moving up. Now here's something most people don't think about. Interest rates don't affect everyone equally. If you have a lot of debt, rising rates hurt you. If you have a lot of savings, rising rates can help you. So in a strange way, the system redistributes pressure, from savers to borrowers, and back again. And since wealthier individuals tend to hold more assets, They often benefit differently from these shifts than everyone else. Now let's talk about timing, because interest rates don't work instantly. When rates change today, the full effect can take months, even years. It's like steering a massive ship. You turn the wheel now, but the direction changes slowly, which creates a problem. By the time you see the effects clearly, you might have already gone too far. Too low for too long, you get runaway inflation. Too high for too long, you risk crushing growth. And no one can predict it perfectly, not even the people in charge. That's the quiet truth behind the system. It's powerful, but it's not precise. Now let's bring this back to you. Every major financial decision you make is influenced by interest rates. Buying a house, starting a business, saving for retirement. Even your job security can depend on it. Because when companies feel pressure from rising costs, they cut somewhere. And often, that somewhere is people. So interest rates aren't just a financial tool. They're a pressure dial on the entire economy. Turn it one way, things heat up. Turn it the other, things cool down. But here's the part no one really says out loud. There's no perfect setting. Every choice creates winners and losers. Every adjustment fixes one problem and risks another. And the system only works as long as people keep believing in it. Believing that money will hold value, that loans will be repaid, that growth will continue. Because the moment that belief cracks, interest rates stop being a tool and start becoming a signal of something deeper. So the next time you hear that rates have gone up or down, it's not just a number. It's a shift in the cost of everything. A quiet force reshaping decisions, pressure, and risk across the entire system. And the real question isn't whether interest rates will change again. They will. The real question is, when they do, who will feel it the most?